Hi friends, I thought of recording an audiobook on stock market of India. So the first book which I'm reading is Multibaggers: How to Profit from a Mega Return Stocks. What is a multibagger? For the purpose of this audio, I am restricting the definition of multibagger to any stock that can generate a return of greater than 1000%, that is 10-fold return over a 5 to 10 year period. After a rigorous analysis of all the multibaggers that the Indian stock market has produced since 1990, we have identified common characteristics that stock will produce these types of outstanding returns. Since investors can only take advantage of identifiable opportunities, one of the criteria that we have used to narrow down our list was that an alert investor would be able to identify such opportunities. We did not consider companies with limited disclosures that made it impossible to identify them as a possible multi-bagger. It is also important to note that all the companies that fit the criteria we have outlined will not become a multi-bagger. There are challenges in the business execution, management capability, technological factor, as well as the new products, competitions, etc., that will restrict some companies from being able to reach the level that an investor might dream of. One of the key skills to be able to get out of such a situation without getting emotionally attached and stay with only those stocks that go to become a multi-bagger. Are all good companies multi-baggers? In general disclosure, people often refer to certain companies as good companies. There are also an implicit assumption that such companies will make a good investment. We beg to differ. Good companies will become multi-bagger only if they are bought at a good price. Good companies also generate losses for investors if the investor buy their shares at a wrong time. So do not automatically assume that because you are buying a great company, you will get a multi-bagger return. However, if you are able to buy a good company at the time of high pessimism, you are most likely to generate multi-bagger return over a long term. How to generate multi-bagger returns? There are 4 parts to generating a multi-bagger return. Identifying a suitable company. Second, buying its stock at the right time. Third, holding the stock until the potential of the company is more than fully captured in its price. And lastly, and the most important, exit. Each of these 4 parts are very important, and in contemporary stock market literature, a lot of attention is paid to identifying a good company, but rarely ever are the other aspects of generating a multi-bagger returns equally highlighted. Identifying a suitable company. Let us first tackle the identification opportunity. You need to learn to identify potential multi-bagger in industry experiencing growth. In the second chapter, we will outline the criteria for identifying a potential multi-bagger. Investors need to study these criteria carefully and understand them well in order to develop this skill. Buying at the right time. Just because you have identified a potential multi-bagger company does not mean that you should jump in and buy its stock. You need to understand whether you are buying it at the right price. How does one do that? There are few circumstances in which a purchase decision increases the probability of generating a multi-bagger return. Let's consider what these are. Buying a company in a new industry early in its life cycle. You need to identify an industry that is either new or experiencing a positive change that will benefit the companies in the industry. When you need to find suitable investment candidate within the industry. Buying its stock before its widespread recognition of its potential. This would be asking to having bought Hero Honda or Z Telefilms in 1993. Both were good companies in the nascent industry, and in 1993 their potential was not fully recognized. However, this approach is fraught with risk because the new industry may not grow as you envision. It is possible to de-risk this contingency by only buying those companies that are trading at a significant discount to their extrinsic value, the concept which will be covered later in this book. Buying at a price by sales ratio below 1 or price to earning ratio below 10 in a new industry can also significantly protect the down risk. Buying a good company with demonstrated growth in the market panic. This involves looking for a company with proven capabilities in a growing industry. For the purpose of this book, a market panic is a situation in which the market falls for more than 30%. And when the market indexes such as the Sensex and the Nifties are trading at price earning ratio below 12, typically these market panics affect all the companies whether they are good or bad. Therefore, such times share prices even of good companies are beaten down to highly attractive and bargain basement level. These market panics usually occur because of the need for liquidity and a fear psychosis among traders and investors rather than due to any fundamental problem with the companies themselves. Those who have identified suitable companies, as explained in the next chapter, can apply the same valuation as in the first case, namely price per sale ratio or price earning ratio, to purchase square shares of these companies during the market panic. Though the share price may have fallen below your purchase price for a while, good companies at attractive prices will generate good returns over the long run. I'll continue in the next part. Thank you.